I find that staggering that it's like for 150K in retirement, you need $3 million of assets. That is an incredible number.
And that's not saying that that's everybody's number. That 150 grand a year in retirement is a really, really good lifestyle. If you only want $80,000 a year in retirement, which is still a good lifestyle, then we're probably saying it's $1 million net in assets.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. That's James Blair. And today, how much do you need to retire?
We're back in your life, and today we're talking about one of the 4 goals that everybody has. It is number 3 in the list, financial freedom, when we want to retire.
Well, it is the literal $1 million question. How much do I need for when I retire?
In your situation, Mike, it's the $10 million question.
Hell of a lot. All right, so we're talking about retirement today, and this is one of the things that people always just push to the back of the list. KiwiSaver will take care of it. I'll pay the mortgage off. It'll all be fine. No, just like you got to make an active choice on your KiwiSaver, you've got to make an active choice on your retirement. The earlier you start doing these things, the less you're going to have to sacrifice, the more likely you are to hit that goal. So, James, why does retirement planning matter?
Jeez, if I have to tell people why it matters, then that's probably not a really good start. If you have a lifestyle that you like, when you stop working, you will not be able to maintain that lifestyle unless you put some money away for future you. And if you've got children, you will be a liability on them, and nobody wants to do that.
Yeah, I always think about that TV1 investigative report on poverty and homelessness and retirement, and that was a tough watch, man. Like, that was very, very sad.
Yep. So rule number 1, KiwiSaver will not be enough by itself. New Zealand superannuation will not be enough by itself. So while those things can help us, and with KiwiSaver, we need to make sure that it is working as hard as it can for us. If we are just planning on that, we think our 3% is going to get us there. That's just not reality.
Yeah, and if you think about a real life comparison, Australia, 11%, shortly growing to 12%. That is going to get you. You have the rest of that gap to make up with your retirement planning. So, what are the factors we should be taking into account when we're looking at these retirement planning metrics, James?
Oh, talking to me about metrics, Michael. So the big thing is what is the cost of my lifestyle right now? So if you've got a mortgage, I would exclude that cost because hopefully we've paid off the mortgage on our own home. If you're renting, obviously you will have to continue with that cost. But I would go, what is the cost of my current lifestyle, and what do I think my lifestyle will then look like in retirement? Now, some people go to me, James, I know I spend $200,000 a year now, but in retirement it's okay, I'm only going to spend $50,000 a year. And that is just completely unrealistic.
Yeah, look, even I know that that's not achievable for me. But that is really important, right? Is what is the lifestyle you want, right? And there's no point in retiring, working your whole life, retiring, and then having to sit at home. You can't go overseas. You can't go see your kids on holiday when they're living over there. You can't do a whole lot of cool stuff they actually really want to do. And the other thing is, think about when we need to spend that money. You need to spend more at the start and less at the end, excluding healthcare, because that's when you're more active.
Yeah, retirement costs tend to be a bit of a U-shape. So when you are young and you are traveling a lot, it will be more expensive. Then it will drop as you can't do those big trips anymore. And then sadly, if you live long enough, it'll go up because of rest home costs. Now, with the rest home costs, potentially not as big of a deal because you might have a house that you sell at that point. But to come back to the cost of your current lifestyle, let's say it's $100,000 a year right now. The other question you've got to ask yourself is, what are the additional things that I'm doing? Coming back to that travel component, right? We've got to be able to fund that because that might not be something that we're doing right now.
Yeah, 100%. Now, we've started with the basics, the groundwork. We're thinking about what do we earn? What do we spend? What do we want to spend in retirement? What does that lifestyle look like? How do we build your future retirement fund? What do we actually do to get ourselves there?
Well, I mean, the good thing is we've got 300 episodes on how to grow your wealth, but it's really about going, what are the steps I need to take to grow my wealth? And then coming to what is the end goal? So you need to know your number. And here's a really easy rule of thumb for you so you can, at a very high level, work out what your number should be. So first, exclude the value of your house unless you plan to downsize. Let's say you want $100,000 a year in income. Firstly, we've got New Zealand superannuation. So that's about $35,000. That means we have a $70,000 gap per annum. If we just said we make a 5% return on our investments after tax, $1.4 million would be a good number in that situation. If you want $150,000, you probably need $3 million in assets. So I would apply the rule of the 5% number there. The other piece to take in mind as well is if you retire later, you will not need as much money because it doesn't have to last you as long. If we're retiring earlier, we're going to need a hell of a lot more money.
I find that staggering that it's like for 150K in retirement, you need $3 million of assets. That is an incredible number.
And that's not saying that that's everybody's number. That 150 grand a year in retirement is a really, really good lifestyle. If you only want $80,000 a year in retirement, which is still a good lifestyle, then we're probably saying it's $1 million net in assets.
Yeah. Okay. Right. So then we're talking about the number we've got to get to. We've got that nailed down. I just want to quickly touch on the superannuation. We, with our customers, always say to them, if they're under a certain age, don't think it's going to be there or don't think it's going to be there in the same kind of iteration, basically. Do you think that's going to change significantly over our life? And do you think it's going to get worse for people as they move into retirement?
Who knows? My big thing is you shouldn't be dependent on somebody else for your future. You should be making sure you're taking control of your own future. So I would completely dismiss New Zealand superannuation if you were under 50.
So then what is the strategy we're actually using to grow that wealth? We know the number we need. How are we going to get there?
Cool. So obviously this is different for everybody depending on their financial position. So some of the key components, one is making an active choice of KiwiSaver, contributions, making sure you're in the right risk profile.
Yep.
If you want to try to get to $2 million, $3 million, that's going to be very hard to do with just your KiwiSaver, but it helps. Then you need to go, if I have a mortgage, what age am I going to have to pay off my mortgage by? And am I going to have investment property as part of my strategy? Do I have some equity? Am I buying a property? Am I buying 2 properties? What does that look like? And then the final component is once I've paid off my mortgage, I'm regularly contributing to shares. $3 million as an end goal for retirement is very daunting. But if I go, you need to increase your mortgage repayments by $100 a week, and then I've mapped it all out and you're going to be fine. And if you buy one investment property in 2 years, the second in 5 years, you pay off your mortgage by this date, your mortgage repayments then go towards a fund and this all works. That is actually really simple. It's like, I can do that, but $3 million, that's completely unachievable.
Yeah. And again, that's the thing. It's when we're looking at these big goals, you've got to break it down piece by piece. And the other thing that's really difficult for humans is humans don't think on 10, 20, 30-year time horizons, which is what people are looking at when they were looking at retirement. So actually, yeah, $3 million, that's a big number. But if you chunk that over 30 years and a number of different assets and investments, it actually does become achievable.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. Budgeting and expenses for retirement, should I aim to be debt-free or can I actually carry some debt into retirement? Let's start there.
Investment property debt, yes. Your own mortgage, no. Now, it is probably important to know, and you'll be able to say this as a mortgage broker, right? More people will be going into retirement with debt, but to carry your biggest expense when you lose your income, that carries huge amounts of risk.
Yeah, and we do see it where people you can see them heading towards trouble. Like they've been on interest only for 10 years, 15 years on their own occupied home. And I'm like, you've lost half the time to pay this thing off.
Yeah.
And in that time, they've had kids. Yep. They started businesses. They're doing things. Those add expenses where they think, I can maintain my lifestyle because that's on interest only. And we actually are starting to see it with people who during the kind of peak of the market in terms of interest rates have put themselves on interest only and are not coming off interest only. So they're staying on it for too long. So you've really got to be careful with the mortgage stuff. You've just got to clear that debt as quick as you can.
Yeah, but let's talk a little bit about investment properties for a second. So a lot of Kiwis make a lot of money from investment property. One thing I would say when you start to plan in retirement and once you hit retirement is property is an asset that makes you rich on paper, but it's quite hard to get meaningful cash flow. Some people go, well, I'm going to sell one investment property, pay off the mortgage of the other, and then I get to keep property. The problem with that is you still have maintenance, you have to pay tax on the income, and it's still going up in value. You're not getting that. I think managed funds, KiwiSaver, once you hit over 65, they're really good assets to be using. I'm not saying you have to sell all your property in retirement, but you've just got to make sure you've worked out how you turn your asset base into income so you can live the life that you want opposed to dying rich.
Yeah. And again, having that money on paper looks great, but James and I know in our personal experience, even though there might be some equity sitting on paper, the costs associated with investment properties over time do really chew in to that net return. So that's why you should be looking at different asset classes once you're getting a bit closer to retirement. Let's say I am a little bit later in the piece. Let's say I am, I've just found checks and balances. I've just listened to all 300 episodes. I've just clocked to this one. I've gone, crikey, I've left this late. What should I be doing? Is it head in the sand time or should I panic?
The answer is the best time to have done this is yesterday. The next best time is today. I've certainly run into people where they've come to me at 60 and said it's too late. And once you just work out, okay, maybe we can't get all of the things we want and be able to retire, at 65 with this great income. But what are the things that we can do so our retirement is better than the way it's looking right now? It's very tempting to put our head in the sand and go, too late, can't do anything, and continue to live the bad habits that have got us where we have, but make the most of the time you got.
Yeah. And I would say if you are thinking, I might be in that position or getting close to that position, and you're going, how do I break these bad habits? Get some accountability. Even if it's not with us, speak to a financial advisor. Get a plan and go, we're going to stick to this and we're going to take some accountability now. I would, especially if you're a couple, couples do not like talking about money. There's enough trash, to talk about with what's going on and this person's done this and I don't like this and you're having an argument. You do not want to throw money into that mix. So a bit of accountability with a financial advisor can be great at that point and really help you get there for retirement.
So I just want to jump on one thing for those who are saying a little bit later in life is sometimes it's actually not that bad. I run the projections. It actually looks pretty good, but you've reduced all of this stress, all of this worry. So I'd also go, I talk to a lot of people and go, actually, you've built this up because I have the metric of hundreds of other households. You just have your lifestyle and what you perceive as what others' lifestyles are when they may not be sustainable.
Yeah, it's a great point. So to finish it off, James, we're going to quick fire some questions at you. Why don't you give me your gut answers? All right, James, Cameron, DeCourcy, Roadhouse, Blair. What is the biggest mistake people make when planning for retirement?
Not planning. They're just living their current lifestyle. They're not thinking about their future at all. And also thinking it's harder than it actually is.
Cool. If you could only invest in one thing for retirement, what would it be?
So the first one is you want to invest into yourself. You want to get your income high enough. The reality is it's really hard in terms of cost of living if your income's not at a certain point. Then we want to be staying away from bad debts. Then we want to pay off our mortgage. Then we want to be buying investment properties. We want to be sorting our KiwiSaver out. Then we want to be contributing to shares.
Cool. So what is the ideal age to start seriously thinking about retirement?
I mean, the obvious age is when you're still in the womb. Longest time that we've got to invest. I'm sure there'll be some provider that'll open an investment account for you.
Yeah.
Because it's great lifetime value of that client. The reality is it's very hard to get people in the 20s to be thinking about their mortality, about getting older. The best time is as soon as this clicks. If you are watching checks and balances, you are thinking about your finances. So if you do not have a financial plan, if you do not have a retirement plan, if you do not have clear goals, this is the time to be doing it.
You mean they're not just watching this because we're good looking?
I think they're listening to the audio if they're thinking we're good looking. Awesome. Okay, so there are all the tips when it comes to retirement. The other thing I'd say is, we're talking about investment properties. $3 million for retirement. Please just take the concepts, apply it to your own stage. What are the smallest steps you can take to be able to get where you want to get to? Write down those goals. What do you want to do over the quarter, over the year? Just really break it down.
100%.
If you've got any questions about your retirement, if you want us to do another episode on retirement, put it in the comments. Much love to Partners Life for sponsoring this episode. Please make sure to subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.